Hey guys, thanks for stopping in to check out today's video. This is Emily Lopez. I'm glad to see you again or see you for the first time if this is the first time you're here. Today what I want to talk about is how do you decide how much you should spend when buying a house? Well, the number one thing that's going to help you narrow it down is you're going to go to a lender and you're going to get pre-approved or pre-qualified, and they're going to tell you, this is the max we're willing to loan you. This is the max that we will let you borrow to purchase a home. However, what a lot of people don't think about is just because you're pre-approved for that amount of money doesn't mean you have to spend that amount of money. What I would encourage you to do is talk to your lender about what monthly payment you're comfortable with after you get those numbers and see if you're pre-approved for $300,000, that monthly payment might not be comfortable to you. Maybe you're comfortable more at like a $225,000 house, and you need to see the numbers broken down for you to do that. So one thing I want to talk about is mortgage calculators online. There's Bankrate has them, a lot of banking websites. There's an app called Carl's Mortgage Calculator. There's tons of places where you can calculate your mortgage. But I need you to remember that there's things that a lot of people leave out. So I have my app on my phone here today that I look at a lot. It's called Carl with a K, Carl's Mortgage Calculator. And it's super helpful. So what I'm doing is a property value of $200,000. So if you bought a house for $200,000, you did a 3.5% down payment, which would be $7,000, which an FHA loan is 3.5% down. So that's a loan that we see a lot of. Your total loan amount would be $193,000. And say you had a 5% interest rate on a 30-year loan, your monthly payment, your principal and your interest, which means the money the bank's making, the interest, and the principal, the amount you're paying down on the loan every month, that would be $1,036.07. But what are you not factoring into that? The other things you have to think about are your annual insurance on the property and your annual taxes on the property, because every month you have to pay a portion of those that add up to the full amount that's due every year. So I am assuming on this loan that was $1,036.07 that we're paying $800 a year on insurance and $1,500 a year on annual taxes. That takes that payment from $1,036.07 a month up to $1,227.73 a month. On top of that, if you don't put 20% down on a property, unless it's a VA loan, you're gonna pay mortgage insurance, which is another fee that the bank assesses because your loan's a little riskier if you don't put 20% down. And so they're gonna charge you, depending on the type of loan, an amount of money per month. Sometimes it's $50, sometimes it's 150 extra bucks, sometimes it's 200 extra bucks. So depending on the type of the loan, that could add $200 more. So that could take your loan from $1,036.07 a month, principal interest, all the way up to potentially $1,400 or $1,500 a month. So that's why you want to talk to your lender about what are all the fees that are going to be included, because when they say, hey, you can spend $200,000, you don't think my payment might be $1,400 a month. You're thinking $1,036 because that's what the calculator told you. So sit down with your lender, tell them what you're comfortable spending a month, and then they're going to help you reverse that backwards to see really what price point you should be looking in. Just because you get pre-qualified for this much doesn't mean you have to spend that much, and that might not be the best decision for you and your family. Thank you for stopping in today. I appreciate you taking the time to watch our video. Please subscribe, please comment in the comments below, let us know what you want to see next, and I hope to see you guys soon. Thank you so much.